Hi everybody, I'm Nate Stewart. I'm a loan officer with Collab Lending, and in today's video, I'm going to tell you how you can try to get the lowest mortgage rate possible. Everybody wants a low rate, low interest rate. So in today's video, that's what we're going to talk about. I'm going to do my very best to stay on task. I have a tendency to be a bit too detailed. So you see, when amortization type is equal to... Oh, okay. So let's jump in. Okay, so first things first, let's talk about what is an interest rate. Very briefly, it's the cost to borrow the money. Obviously, right? So if you find a house that costs a couple $100,000 and the lender over here has the pot of money and you want access to it, they're charging you an interest rate. That's the cost of borrowing that money. Another way of looking at an interest rate is that it's a reflection of the risk that the lender sees and the likelihood that you're going to repay that loan. It's also a reflection of how much money the lender thinks that they're going to make on you as a client, right? So can they just make money on the interest rate, or can they make money on the servicing as well, like how you're paying the loan back? Or can they also make money on when you come in to ask for the mortgage, can they add on other accounts like the checking account, the credit card account, the savings account, all these other things. You can get a really low rate, maybe if you don't mind having higher closing costs, and vice versa. So it's always going to be a give and take. Okay, let's look at what the factors are that are going to influence the rates that you're going to have access to, right? Because the truth is that as any borrower walking around, they have access. You actually have access to a range of different rates, and so as we identify these different factors, we're going to hone in on what the real rates are that you're going to have access to. All right. So one of those factors is one of the main ones is the intended use of the property. Is it going to be for your primary home? Is it a second home or vacation home for you, or is it an investment property? Another factor is what type of loan program. Are we talking conventional loan program? Are we going to go with a government loan program like FHA, VA, USDA? Or are we talking like non-QM, those kinds of loan programs that are, for alternate types of income sources to repay the loan? That's called non-QM. Another factor is the location of the property. This can be all the way down to, it's the state, it's even down to the zip code. Some states have, certain kinds of natural disasters, whereas other states might not see those same types of disasters, even down to the zip code. Another factor is obviously going to be credit score, right? The higher your FICO score, the less risk a lender is going to see in you being able to repay that loan. So you're going to have access to lower rates, right? Credit is a moving target. We'll talk about some tips to get that credit score up as high as possible so you can have the lowest and best rate, but credit score, obviously going to be a huge factor. There's also the size of your down payment, right? Sometimes in the biz, that's called loan to value. Okay, so it's like, are you trying to finance, like with VA, and USDA, you can finance 100% of the value of the property, right? Whatever it appraises for, you can borrow that much potentially, okay? But in other loan programs like conventional, you can only borrow 95%. So that would be you having to put 5% down. Usually, the more money you put down, typically the lower the interest rate's going to be, right? Because you've already paid in a bunch of money. So for the lender, they've got that money already paid towards the principal of your loan. And if you default, you start missing payments and aren't able to pay it back. If they come and they take that property from you in foreclosure, they've already got a bunch of that equity in the equation. So that's a factor that's also going to affect interest rates. Then we've got property type, right? Is it a single family home or a condominium or a multi-unit? Of all those different types, your single family home scenarios are going to have the lowest rates versus condominiums, because that's a form of shared ownership, right? It's like a bunch of different people all kind of sharing ownership of a structure. And then multi-units, of all those different scenarios, the single family is going to have the lower rate. Most lenders are also going to adjust the interest rate based on the loan amount. Okay, so are we talking less than 100,000, 100 to 150, 150 to 300? So this is kind of lender specific, but there are differences in the rate that you can see, and these are smaller differences than these other factors we've talked about. But that how big of a loan you're asking for is definitely going to affect the size of your interest rate. Then we've got debt to income ratio, which is basically how much of your income that you're using to repay the loan, how much of that income is going towards debt. If it's below 40%, including the new mortgage, if your debt to income ratio is 40% or below, you're probably in good shape to have the lowest rate available to you. If we go over 40%, you're going to see a hit on that rate. Like if you're spending 50% of your income monthly on on debts, including the new mortgage, they're going to hit you on the rate for that. So the rate would go up for that reason. Then we've got loan term, or how long is the loan going to be for? Is it going to be for 30 years, 40 years, which is now a thing, right? Or is it going to be for 15 or 20 years? So if the difference in how long you have to repay the loan could affect the interest rate as well. And then there's lesser known factors that can have a big impact on your rate. So for example, that's going to be lock period. So from the time that you turn in a purchase agreement that's signed by you and the sellers, how long are we locking your rate for? Okay, so is it 15 days, 30, 45, 60 days? You can see locks up to 90 days. The longer you want to lock that rate for, typically the higher the rate is that you're going to get at closing. Then there's also underwriting fee, right? So like the underwriting fee, that's just the fee that the lender charges you to go through the process of underwriting. We can roll that into your rate and it goes up a little bit, or you can pay it separately at closing and then you're going to see your rate be a little bit lower. Then there's also originator compensation. Are you going to roll the compensation into the rate and then it'll go up a little bit higher? Or are you going to pay the loan officer's compensation separately at closing as its own line item, and then you can have a lower rate doing it that way? Then there's also, are you going to escrow your taxes and insurance into the monthly payment, or are you going to not escrow them in and keep them separate, which is a little bit riskier from the perspective of the lender, because it's like, oh, if you don't save up enough to pay your property taxes or the insurance, then you might not have it when the bill comes due, and if you might have to miss a payment to cover that, and so that's considered riskier, and your rate's going to go up if you don't escrow taxes and insurance into your monthly payment. And there's also lender credit versus discount points. Do you want to take a little higher rate and then the lender's going to give you some money at closing to kind of help offset closing costs? Or are you willing to pay extra and buy the rate down using what are called discount points at closing? And that will help you get a lower rate. So you see, it's a bunch of different factors. It's too many factors. It's a lot. It's a lot. Okay, let's talk some specific numbers, shall we? So I'm recording this now at the end of March in 2023. So all the numbers that I'm going to discuss, I just priced this out today. And so it's really only relevant for the moment that I price it out, because interest rates, another thing to know is that they're a moving target as well, right? So they're fluctuating with markets, they're fluctuating with news, they're fluctating with all kinds of different things, in addition to the dozen plus factors that we're talking about. Okay, so I have my handy dandy notes here, but I'll put the numbers on the screen during post-production, if you will. Okay, so we've got, I'm gonna talk about the scenario of a single family home set in Florida, 30-year fixed conventional loan, and with a 30-day rate lock. Okay, so that's a bunch of those factors kind of built into this one. Any one of those factors change, and the rate could be very different, right? So let's do $300,000 purchase with 5% down. So that's going to leave a loan amount of $285,000, and let's have a FICO score, a good score of 780. Okay, so at that scenario, okay, that your interest rate today, right now, with one lender would be 5.5% for a conventional loan. I'm not talking about FHA or VA or any of these other programs. That's just a conventional Fannie Freddie program for that loan. Okay, if we just change the FICO score, if we go down from 780 down to 740, then the rate would go up a bit to 5.625%. And if we go down further to 700, the rate would go up a little bit further to 5.75%. All right, let's change a different variable now. So let's back up, put the FICO back to 780, and now we're gonna change the down payment amount. Instead of it being 5% like in the first one, let's do it with 10% now, okay? So all of the other factors are gonna be the same except 10% for a down payment. For that scenario, you'd have an interest rate of 5.375. This kind of makes sense with what we've been talking about, right? If you buy in more equity, a little bit less risk from the perspective of the lender, and so they're gonna lower your rate down to 5.375. It was 5.5, right, with a 5% down payment, because they're giving you a bunch more of the value, or a bit more of the value of the property. And if you can put down more money, they get a little bit of equity starting off, they'll lower the rate for you. All right, let's keep adjusting the down payment amount, okay? Let's keep all the other factors the same, 300,000 of a purchase. Now let's do 20% down and keep the FICO score at 780. So at that scenario, the rate goes back up a little bit to 5.5%. How can that be? That's because, remember, one of the factors is they want to see how much money they can make on you. And so one of the most common scenarios is 20% down, because folks know if they can go with 20% down, that's going to remove the mortgage insurance part of their payment. So their payment could still be lower, even though that rate could tick up a little bit. Now, this is lender specific. This could change day to day, but this is an example of how interest rates may not be as intuitive as you expect. And just because they know that a lot of people, if they can put 20% down, that's what they're going to do. It's such a popular scenario that supply and demand. So they're going to take the rate up on 20% down. Then if we're going to do 25% down, all the other variables the same, now the rate comes back down to 5.375. So this might be interesting to you because people would probably think, well, the more I'm putting down, the lower and lower and lower the rate's going to be. Not necessarily, right? It depends on a bunch of factors. This is why when you call in and you just say, hey, what rate am I going to get? It depends. It depends on a lot of things. Okay, so what are some things that you can do as a borrower to try to get the best possible rate? Well, big surprise coming. Have good credit. Yeah, shocker, right? No, everybody knows that one. But what are some actionable things that you can do to improve the credit if you want to have the best credit possible? One is limit your debt utilization. What does that mean? Basically, if you have a credit card and the limit is 10 grand, well, you don't want to use more than a third of your credit limit on any given credit card or any given loan. Okay, so try to keep your debt utilization to 1/3 of the maximum that you could possibly borrow. That will help make your score go up. Another huge one is making your payments on time. If you miss just one payment or you're short on a payment, they're going to dock you. That FICO score is going to go down, and that's going to, as we saw before, that's going to affect the rate that you're going to have access to. Another thing you can do is just go and get your credit report. You're entitled to a free one. I'll put a link in the description. You're entitled to a free one once a year, and look on there. Take a look. Are they hitting you for late payments that were not actually late? Are there trade lines on there that are not yours that could be fraudulent? There's a bunch of different ways there can be mistakes on your credit report, and those things will affect your score, and that will affect what rates you have access to. Another thing you can do is be trying to save for a good down payment. We saw before that just the size of the down payment doesn't guarantee that the rate might be lower, right? Because a 20% down payment had the same interest rate as a 5% down payment. And so what you want to do is you're trying to get, interest rates are only important as a function of how it affects your monthly payment. And so if you can save up for a good sized down payment, then you're going to be able to have a lower monthly payment, possibly a lower interest rate. So, one tip to how to make the savings happen is try to make the savings automatic, that before it even hits your bank account, that you've got an account that some of the money, just a little percentage, just could be 1 or 2 or 3% or a set dollar amount of your income is getting deposited with every single paycheck, or every single, bit of income that you get is getting saved that way. So that can help you save up, and those things add up. And that'll help you with your interest rate when it comes time to purchase a home. And another important tip for having the best interest rate possible is to have a good loan officer, somebody who's experienced, somebody who has access to a bunch of different loan programs, someone that's going to sit and listen to what your priorities are, what you're trying to do, and that they have enough knowledge about the market that they can try to do the shopping of the interest rates for you, right? And so if only I knew somebody like that. Okay, so we've seen that your mortgage interest rate is affected by a whole bunch of different factors, right? And changing just any one of them is going to affect what interest rate you actually get at closing. And so what I encourage folks to do is to think more about their monthly payment, their whole monthly payment, right? The principal, the interest, the taxes, and the insurance and HOAs. Because someone might be very sensitive to the interest rate, and they're wheeling and dealing to try to get that rate down as low as they can, but then they're going to purchase a property in a county where the property taxes are out the roof, or in a zip code where there's flooding, they have to pay for flood insurance, or in another community where there's HOAs that's going to be, drive up the cost of their monthly payment. So think about all of these different factors. The interest rate is obviously an important one, and obviously, one that borrowers have been trained to ask for, but your monthly payment is really built on a bunch of different things, and it could also have mortgage insurance attached to that. So it's, at the end of the day, how does your monthly payment look? If your monthly payment makes sense for a given scenario, a given property, then you're probably going to be in good shape to make that purchase. Because another factor is that the mortgage interest is tax deductible. You get to write that off. They deduct that from your tax burden at the end of the year. So that's what I would encourage people to think about, is the full monthly payment, and how obviously the interest rate's a factor there, but what are all the factors? And that's why it's important to have a good loan officer help you take a look at your scenario and tell you how would all the factors for your specific scenario add up to your monthly payment and which interest rate you have access to. Thanks very much for watching. I hope you found this helpful. If you did, feel free to like, drop a comment, subscribe, share to somebody that you know is maybe looking. And also, if you would like some help, some specific help figuring out what interest rates you're going to have access to for the specifics of your scenario, please reach out to me. My contact info is going to be in the description. Happy to help anybody who's purchasing in Florida or Puerto Rico, originate in both of those places. So thank you very much for watching. I'll see you next time.